All right, let's talk Millrose Properties, ticker MRP. We're diving deep into their Q2 2025 earnings call today, and believe me, there's a lot to unpack here.
So right off the bat, the market seemed to love what it heard. The stock jumped almost 3% in the pre-market. But here's the interesting part. The headline numbers weren't actually a clean sweep. So what gives? Why were traders so bullish? That's the big question we're going to answer. Let's get into it.
Okay, so what's our big takeaway? We're calling this one constructively bullish. And what that really means is that investors looked right past a tiny 1-cent miss on earnings. They just didn't care. You know why? Because the bigger story was so much better. We're talking a solid revenue beat, a dividend that's looking rock solid, and a management team that sounded incredibly confident about the future.
And this right here is such a great lesson about the market, isn't it? The narrative, the forward-looking strategy, that stuff can totally outweigh one little data point. It's all about where the ship is heading, not just the wake it left behind. So let's go ahead and look at the actual numbers that got everyone so excited.
All right, let's get into the Q2 financial snapshot. Time to look at the numbers behind this whole narrative.
Okay, take a look at this. You can see it right there. The GAAP EPS came in at 68 cents, just 1 penny shy of what the street was expecting. But, and this is a big but, look at the revenue. Almost $150 million, beating estimates by a cool $3.6 million. That's a solid beat. But the real story, the thing that kind of changes the game here, is this new metric they rolled out, AFFO.
So, what is AFFO? It stands for Adjusted Funds from Operations. Think of it as management's way of saying, hey, forget the weird accounting stuff for a second. This is the real cash our business is spitting out. It's a much cleaner look at their actual earnings power. And why is that so important? Well, that number, 69 cents per share, tells you they have more than enough actual cash to cover their dividend. That's huge for investor confidence. Okay, so you see the numbers, but the real question is how are they doing it? How are they generating that cash? Well, it all boils down to their core strategy, something they call the operational flywheel. It's a pretty cool concept.
Here's the thing you have to understand about Millrose. They aren't your typical real estate company that just buys a bunch of land and sits on it. Nope. They're more like a bank for home builders. They provide the capital, they manage the land, and they deliver it to builders just in time. They're basically a utility for the home building industry, making everything way more efficient.
And this is how that flywheel works. It's a simple but really powerful cycle. They sell off home sites to their builder partners, bam, they get cash. They take that cash and immediately redeploy it into buying new land for new deals. And those new deals generate predictable fee income. The whole thing just keeps spinning, faster and faster, fueling more and more growth. It's a self-perpetuating machine.
And when I say it's accelerating, I'm not kidding. Just look at this number. In the second quarter alone, they pumped $813 million into new deals. And get this, that's all with partners other than their main client, Lennar. This is huge. It proves their model isn't just a one-trick pony. There's massive demand for what they're doing.
And they're not just sticking to the basics either. They're getting really creative with this platform. The CEO, Darren Richmond, pointed this out. They facilitated a nearly $500 million capital backstop for another company's deal to go private. I mean, think about that. It just shows how flexible and powerful their capital platform has become.
But this next one might be the biggest deal of all. They announced a partnership with Taylor Morrison to get into the build-to-rent space, and it's not a small deal. We're talking about a $3 billion capital partnership. This is an absolute game changer. It takes their model and plugs it directly into the booming single-family rental market. Huge diversification.
Okay, so you hear about all this rapid growth, all this money flying around, and you're probably thinking, what about the risk, right? Well, they have a pretty solid answer for that. A staggering 97% of their portfolio is protected by these things called pooling agreements. It's a clever way to spread risk across multiple projects, giving them some serious downside protection.
All right, that brings us to the road ahead. Given everything we've just seen, what are they telling us to expect? Let's look at their guidance and the key catalysts.
And here it is. The proof is in the pudding. They took their guidance for that key AFFO metric and bumped it up. They're now guiding for a year-end run rate of 70 to 73 cents per share. You know, when a management team raises guidance like this, it's not just a number. It's a massive vote of confidence in their own business. So if you're an investor or even just watching this story unfold, here's what you need to have on your radar. First, are they going to hit that new, higher AFFO number? Second, keep your eyes peeled for more of those big build-to-rent deals. Third, watch how they finance all this growth. Are they tapping the bond market? And finally, the big one, any whispers about a potential conversion to a REIT? That's a huge potential catalyst.
Okay, now for the part you've been waiting for, the next call. We've broken down the quarter, we've looked at the strategy, so what's the actual trade idea? What's our take?
So, what's the tree?
We're calling this one the built-to-rent to REIT arbitrage play.
Okay, so here's the entire thesis in a nutshell. Right now, the market is valuing MRP like a niche land banking company, but we think that's missing the point. With this huge push into build-to-rent, they're basically becoming a future single-family rental landlord. The moment they flip the switch and convert to a REIT, a whole new universe of income investors and REIT ETFs will be forced to buy the stock. We think that could trigger a massive re-rating, closing the valuation gap between what it is now and what a big residential REIT trades for. That gap, that's the arbitrage.
So, when you put it all together, the operational momentum is firing on all cylinders. You have clear growth catalysts on the horizon, and you have this potential for a huge structural re-rating. For us, the rating is a clear outperform.
And that leaves us with one final big question to think about. With this incredibly innovative flywheel model and all these new ways they're using it, is it possible that Millrose isn't just building a great company, but they're actually changing the fundamental plumbing of how capital flows into the entire home building ecosystem? It's something to think about.
And of course, just a reminder that this analysis is purely for informational purposes. It is absolutely not financial advice.